The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box Europe. We are live from Davos and from London. I'm Steve Sedgwick with Karen Cho and Juliana Tattlebaum, and these are your headlines. Futures on Wall Street move deeper into the red as the standoff over Greenland ripples through global markets, with the US president delivering this message before departing for Davos.
I don't think they're going to push back too much. Look, we have to have it. They have to have this done. They can't protect it.
President Trump makes a specific threat now to the French president, Emmanuel Macron, after he rejects an invitation to join the Board of Peace, with the US leader warning of harsh consequences.
What I'll do is, if they feel like Costco, I'll put a 200% tariff on his wines and champagnes, and he'll join.
Thank you. President Trump takes aim at the UK while aboard Air Force One, branding its deal on the Kaeser Islands as an act of great stupidity. The U.S. Treasury Secretary Scott Bessent dismisses Europe's ability to hit back at tariffs, describing retaliation as unwise, as Siemens Energy Chairman Joe Kaeser calls for continued dialogue with the U.S. administration.
The trade bazooka was initially introduced by President Macron. If you don't talk anymore and try to shoot, that is rather a bad idea.
Well, a very good morning to Davos, or to all of you, to the Davos World Economic Forum from Karen and myself as well. The news flow is quite extraordinary, so we'll get straight into that if we can. President Trump says he will be meeting with various parties involved in his row over Greenland during his visit to Davos, after what he described as a very good call with the NATO Secretary General Mark Rutte. Writing on Truth Social, he said Greenland is imperative for national and world security. There can be no going back, a point he reiterated as he departed for Davos.
I don't think they're going to push back too much. Look, we have to have it. They have to have this done. They can't protect it. Denmark, they're wonderful people. And I know the leaders, they're very good people, but they don't even go there. And, you know, because the boat went there 500 years ago and then left, that doesn't give you title to property. So we'll be talking about it with the various people. We've had tremendous success, and I've done more for NATO than anybody else.
Meanwhile, Trump also threatened a 200% tariff on French wines and champagne, which he says may push French President Macron to join his Board of Peace initiative.
Did he say that? Well, nobody wants him because he's going to be out of office very soon. So, that's all right. What I'll do is, if they feel like Costco, I'll put a 200% tariff on his wines and champagnes, and he'll join. But he doesn't have to join. If he said that, you're probably giving it to me a little bit differently. But if he actually did say that, but as you know, he's going to be out of office in a few months.
US President Donald Trump has also criticised the UK over its agreement to give the Chagos Islands to Mauritius, calling it an act of, quote, great stupidity, and warning it will be perceived as weakness by Russia and China. The UK government is giving up the islands and will lease back the joint US-UK military base on the island of Diego Garcia for £101 million a year. So as we kick off the World Economic Forum, I think we were starting out a year in 2026 where many had hoped there'd be fresh momentum again for economies, parking the tariff threat behind us. But we've now doubled down to tariff threats, big allies as well, the US and Europe, whether we do see that retaliatory weapon that Europe has been keeping on the sidelines for now, the trade bazooka. So certainly elevated tension as we get going for the World Economic Forum.
Yeah, It's extraordinary and unprecedented and increasingly terrifying for everybody who is worried about the world order as well. Unless you're an authoritarian leader around the world, you must be quite excited about what you're seeing, which is an implosion of Western historic alliances that have kept peace and kept liberal democracies relevant for so many years post Second World War. I've been doing a bit of informal canvassing of CEOs, and I continue to do so, saying, what do you think and what can rein in the US president? Because he seems to be firing off left, right and centre against a whole host of allies, whether it's the EU, whether it's NATO, whether it's individual countries, and every single day brings a new tariff threat. So the question I've been asking is, what can rein the US aggressive policy in? Because something needs to change as well. Is it his base? Is it Republicans in the House and Senate? Is it the financiers who support Donald Trump as well? Or is it the bond market? And very interestingly, a lot of the CEOs have said to me, there is only one thing that can actually make the US president or the US administration more broadly rein in some of its more aggressive protestations against allies and this aggressive ramping up of tariffs. And that is the bond market. And it's very interesting. I'll just say briefly that the 10-year yield on the US paper has gone up from around about 4.17 the last time you and I were on air a week ago, or a few days ago, to around about 4.27 now. So if we want to look at one thing, if I had to say one thing that our viewers should look at, it's the bond market. I'll
pick up on a couple of those points. First up around the bond market, fascinating because don't forget, in this huge trade bazooka that the Europeans have, it is the ability to restrict some of the bond purchases of US treasuries. Trump has dismissed that narrative to an extent, but keep in mind, biggest investor into the United States is Europe. So it does come with some serious connotations if Europe is saying they're going to hold back, of course, access to the single market. There's technology companies. You think about all the deals that we've had around AI. It's a lot of domestic investing alongside big US technology companies. So there's a lot at risk for those big tech names. The other points you raised about what the motivation is for Trump right now, the executives I've spoken to said, look, we thought it was all about the midterms. They're laser focused on the midterms. It's extraordinary that we're now getting these international events that would seemingly be somewhat distracting for the president, trying to double down on the affordability issues. And we know he's been tackling affordability through exposure to single family homes who can own them, for instance, tackling the 10% cap on credit cards.
That makes total sense. Look at domestic issues. This is a president who was elected to focus on inflation. The reason why, above all else, that Joe Biden lost, Kamala Harris, stroke Joe Biden, lost, there's a Freudian slip, lost the election is because they failed to focus on the matters that matter most to Americans, which is inflation and the cost of eggs, the cost of gasoline, and their economic well-being as well. It isn't the fate of Greenland. It isn't the fate of NATO as well. It isn't the fate of Diego Garcia in the Chagos Islands and a 99-year lease that the Brits may or may not have signed with Mauritius. It's extraordinary that a president who said America first and was going to pull back from US adventurism has gone to foreign policy initiatives to try and bolster his ratings. That I find quite extraordinary. Anyway, our job is nothing but exciting. We are privileged to be in this position, and we'll hopefully bring you all the conversations that we're hearing off camera as well as on camera. Maybe some of them will have to temper the names. Anyway, US futures, let's take a look at where they look at the moment. We are cooled down. I think these are significant moves. I wouldn't say they are particularly dramatic moves given some of the record levels we've seen as of late. Karen.
One of the challenges today is for European leaders, world leaders, to get their message across before tomorrow, because tomorrow all eyes will be on President Trump when he visits Davos on Wednesday. We will get key insight when he sits down with our very own CNBC's Joe Kernan. That is right here on CNBC, here live in Davos. Now, we've been speaking to business and political leaders here in Davos about the impact of President Trump's tariff threats and how investors and countries should respond.
It's not chaotic, but the world is becoming more fragmented, without a doubt. And so, like I said, that will come with its own opportunity, but pitfalls as well. So I think navigating things like localizing supply chains, so that's one really important theme. Navigating how the markets are going to behave, navigating what the big themes are going to be over time in that more fragmented world is not riskless.
When the tariff challenges started last year, everybody thought that, it's the end of the world. We ended up actually seeing that economies adjust businesses adjust. What they need is certainty. And what we call for is that. What we call for is dispute is resolved by dialogue, that the world problems are discussed and resolved through dialogue. A lot of issues will need to be discussed and resolved through that channel.
The trade bazooka was initially introduced by President Macron, right? And if you don't talk anymore and try to shoot, that is rather a bad idea.
Right, well, I'm delighted to say, kicking off our coverage this morning is David Schwimmer, who's the CEO of LSEG. I want to talk to David about trade. I want to talk to him about digitisation, about blockchain, about the London Stock Exchange, about LSEG and data. I've got to ask you, though, about your reaction to events. We're asking all the CEOs, how do you see the dangers to the global financial system from what we're seeing from the US president at the moment?
So the geopolitics have been pretty extraordinary over the beginning of this year. I think the markets are unsure how to react. And we've seen, no trading day in the U.S. yesterday, which is particularly interesting. We've seen a little bit of weakness in treasuries, a little bit of weakness in the dollar, which is frankly, in normal times of geopolitical uncertainty, unusual. When you have geopolitical uncertainty, usually there's a flight to safety, and the dollar strengthens and treasuries strengthen. So this does appear to be an unusual shift in the paradigm. We saw a similar last April around Liberation Day. So we'll see how it plays out. Last week the news was very different. The week before that, the news was very different. Yeah. So we'll see. Is this a 1 week event, or is this a much more significant transformation?
David, we've all had long careers in and around finance as well, and the biggest fool's game out there is trying to tie global events into markets and saying this macro event will have this effect on markets. It's the easiest way to lose money historically as well. But given what you just said about the dollar and about the US bond market and the changing relationship between those as safe havens in moments of crisis as well, could we be on the brink? And I know you're not looking to cause alarm, because that is something that none of us want to do. Could we be on the brink of actually a changing relationship between where people will go for their flight to safety?
I think any change along those lines would take place over a very extended period of time. And there has been a bit of diversification over the past year. And you have seen dollar weakness over the past year, and you have seen a modest allocation of capital in either other currencies or in other markets. That, in many ways, is healthy, given the significant over-allocation of capital to the U.S. over the last 10 or 15 years. So it's hard to really answer that question in terms of, is this driven by short-term geopolitics, or is this a much longer-term driver of diversification, a healthy diversification in the markets?
David, we spoke all last year about where animal spirits were and whether the deal making was going to come back, whether the IPOs were going to happen. And the reality was it was a great year last year for you. 23 companies listing on the London stock market, raising £2.1 billion. That was 170% lift year over year. You keep talking about the pipeline looking great as well. When you look at the events and just how volatile they have been in recent weeks, from Venezuela to Greenland to tariffs, escalating threats, do you fear that the pipeline could remain stuck, that IPOs are simply not going to happen now?
Of course, companies prefer to IPO in a stable, growing environment, and they're not excited about enormous volatility and uncertainty. At the same time, we are in a new norm here in terms of the level of activity, the level of news flow, the level of geopolitical uncertainty, and companies want to grow. Companies want to access the public markets. Companies want to raise that growth capital. So we do see a healthy pipeline. Is it possible for the geopolitics to derail the pipeline and derail the environment and shut the IPO window? Sure, it's possible. I think that at this point, I expect to see the pipeline continue to develop, and we expect to see companies coming to access the public markets.
Something we've seen a lot recently has been how Europe responds in a very competitive environment. And one of the ideas floated last year was from Friedrich Merz, the German Chancellor, about one stock exchange in Europe. And we've been talking about that a lot. It feels now that Europe is seeing even more pressure. Do you think this could be an initiative that they try and push ahead with? And where does that leave you? Because it felt like there were lots of conversations happening around you, maybe with you last year, about consolidation.
I don't think that would be a big driver of a change in the economic landscape in Europe. I think there is an opportunity for Europe to do a lot more in terms of consolidation of, if you're talking about market structure specifically, consolidation of the post-trade entities, the settlement CSDs. There are a lot across Europe. I think consolidation of some of the more technical aspects like bankruptcy code, tax regimes, et cetera, all of which has been talked about for 20, 25 years in the context of capital markets union and the savings and investment union. If the EU made progress in those areas, I think that actually would have an impact. I think if the EU allowed more bank consolidation, I think that would have an impact. And I think if there was a receptivity to greater capital market activity relative to just bank lending activity, I think that would also have an impact. So there are lots of things to do that could help facilitate growth in Europe, well beyond the notion of
David?
Stock exchange consolidation.
Let me move beyond stock exchange. The LSEG Group has set its stall out with that enormous 2021 acquisition as well. What's the biggest thing on the agenda for you? I see headlines at tail end of last year saying markets waiting for your AI strategy to bear fruit as well. I had a big conversation with a big financier yesterday who's you said blockchain evangelist as well. What's the next stage in digitization and AI for the London Stock Exchange? Or at LSEG, I should say.
So there's a lot going on with AI, and for us, our data, the demand for our data going into these large language models is very significant. We think that's long-term very interesting and attractive for our business and for the markets. You touched on digitalization. That is also a big theme. We just announced last week our digital settlement house, which is a new way for companies to settle in commercial bank money real time, which doesn't sound like a big deal, but you cannot do that today. And you can do it with our digital settlement house. We call it DISH. Across currencies, on-chain, off-chain. And so that's an example of market infrastructure really changing to adapt to this new digital world.
Squeeze in a final question from me. I know time is of the essence. Very interesting that London and the investment house in London have pushed back on closer alignment with the EU, which is just extraordinary when you consider how desperate they were for alignment and didn't want Brexit as well. Is London doing just fine now, given the fact that it's going to be the big headquarters for Visa is now, big headquarters JP Morgan as well? Are we back on track in London in the financial markets?
I think the whole narrative around London being pushed off track by Brexit got a little bit overplayed.
Right.
And I think London continues to be one of the world's leading financial centers, by far the most international financial center, in great positioning, whether that's in terms of the equity markets, in terms of its foreign exchange derivatives, company headquarters, the legal system. So we're in good shape. I think we've had some benefits in terms of greater flexibility.
Yeah.
And we at the London Stock Exchange Group at LSEG have benefited from some of that in terms of being able to drive reforms that have made listing in the UK better, easier. In terms of the cooperation with the EU, that has also, frankly, worked out relatively well.
Amazing.
There was a lot of concern about the clearing issue a few years ago. You don't hear about that anymore.
Right.
So a lot of these issues really have been resolved, and I think London is in very, very good shape.
David, just very quickly, to your points around tokenization, I've got a big panel tomorrow and it feels like it's really on the agenda. Everyone's talking about rewiring the financial system. Tokenization could be the bulk of all transactions soon. How are you seeing how revolutionary it is going to be, and when is it going to have a big impact?
I think the way to think about it, we've been hearing about blockchain for several years now. I think this year feels like the year where a lot of it becomes legitimate, I'll say conventional in terms of being used, where we're seeing it in our own infrastructure. We're creating it so that you can actually use it in a normal way as opposed to a proof of concept or sort of a science experiment. So that doesn't mean it's going to change everything immediately. Financial market infrastructure in general can be very sticky, There are a lot of incumbent interests. There are benefits to the existing systems in many ways. So I think you'll see more of a hybrid model taking over this year and in future years. I don't expect it to have a wipeout of existing practices and digitization takes over.
We can't tell you how useful these conversations are for when we get in front of the big panels as well. So thank you very much indeed for that. David, lovely to see you, and we'll see you back in London, no doubt, as well. David Schwimmer, of course, the CEO of LSEG. We're going to be speaking to more top executives and policymakers throughout the day on CNBC, including the CEOs of Commerzbank, Novartis and Standard Chartered, as well as the IMF Managing Director, Kristalina Georgieva. Coming up on the agenda here in Davos, the President of the European Commission, Ursula von der Leyen, will be speaking here live at the World Economic Forum in Davos. We're going to bring you that at 10:50 local time. That is 9:50 in London.
In the meantime, up next on the show, we'll be speaking to the CEO of Allianz, Oliver Bäte. That is coming away next.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
As President Trump's tariff threats linked to taking control of Greenland hang over the World Economic Forum here in Davos, we asked the Siemens Energy Chairman Joe Kaeser whether retaliatory tariffs are the right way forward for Europe.
The jury is still out on whether or not things are being executed as they have been announced. We've had, examples in the past where there was an announcement and it got sort of taken back in a way. So we'll see what happens now, February 1st. We'll see what the President of the United States has to tell the world here at the World Economic Forum on Wednesday, and then we'll take it from there. We're all in the same boat, see? We're all in the same boat. And people need to understand it's all on us to keep the world moving. And if one of the very important players is not willing to play, it's bad for everybody.
You said last year that Europe was not prepared for Donald Trump. Since then, we've seen Europe take the impact on tariffs. They didn't retaliate. They took the tariffs trying to keep NATO together, and that the US would be committed to tackling Ukraine. But was Europe simply too weak from the outset with its appeasement strategy?
Well, the challenge in Europe, for Europe, is that there's 27 states with almost 28 different interests. So therefore, it's very hard to bring, a joint foreign economic policy to work. And if you don't have a joint foreign economic policy, it's very hard to bring actions into play. But I think they have been pretty good at aligning themselves more than they used to, including the UK, which is, I think, very important for the greater good of Europe. And so I think they're doing the right things now, to align, to talk to each other, to meet, see what is possible and what is not, so that it doesn't, meet them totally flat-footed if there's another wave of sweeping tariffs.
Is it right for Europe to now think about the retaliatory tariffs, releasing that big trade bazooka?
Yeah, well, I think the trade bazooka was initially introduced by President Macron, right? And, if you if you don't talk anymore and try to shoot, that is rather a bad idea.
Do you think the NATO alliance will hold? Is there a genuine risk that it may come apart?
Look, I was actually attending a reception earlier today up in the mountains with senators, governors of the United States. And if you listen to them, if you talk to them, I believe there's a lot of hope that people of good minds are still prevailing.
I'm pleased to say Oliver Beth has joined us now, the CEO of Allianz. And Oliver, some of my favourite conversations with you over the years have been about how you view risk. As we got going here at the World Economic Forum, WEF was talking about geoeconomics being the number one threat. Of course, we've had Greenland. We've now got threats escalating between the EU and the US. There are concerns around what happened with Venezuela, what it means for other leaders around the world. How are you thinking about risk now in 2026?
There's lots of it. But first of all, good morning, Karen and Steve. We shouldn't forget about the basics. And a beautiful day, you see the sun coming up. We tend to look very short term, and one of the things that are in our business model, even though we manage a lot of money also short term, is to try to look through the noise and look for the signal. And therefore, risk has been piling up for a long time. And people are more concerned about why haven't we seen that in market prices yet? This is what we're concerned. But the most important question is for us, how do we keep our customers safe? I keep on saying that, but that's very important. So we have been de-risking. When people said, yeah, but you lost a lot of money last year on the US dollar, we said, no, we didn't, because we've been hedging the net cash flow in US dollars forward for a long time. And that's what we do.
When you say you're looking through some of the short-term noise, tariffs were incredibly noisy all throughout 2025, and now we seem to have circled back there. A lot of economists are looking at the consequences of those tariffs coming in this year. Do you think there is a risk to be managed around tariffs?
Absolutely, but again, it's a tool being used by people that want to affect a certain outcome. Now, when you go back the many years and say, what's the art of the deal? You can read the scripts that are right there. That doesn't mean it is not dangerous, but we need to sort of, again, what's the noise? What's the signal?
Your job is undoubtedly to look medium to longer term and look through the fog. But you said you were already thinking about de-risking long before the current set of events. Just remind me again what the size of your balance sheet is. I got a feeling it's $1.2 trillion.
Yes, correct.
Right, okay. Any of that you're looking to take off the table from US assets at the moment?
No.
None at all?
No.
Is that doing a disservice given the risk we're seeing around the dollar and indeed the US bond market?
Sorry, you got the question and the answer, because we've been preparing. Right? So we talked about the US dollar before. Europe is particularly long US Treasury, something very important for the US government to think through what it means when people lose trust in holding these assets, right? And we've been talking about that. But we have been carefully and thoughtfully optimizing diversification. That's the point. The only thing that you can do, we can, by the way, just as a reminder, we cannot hold commodities, we can't hold gold for regulatory reasons. People say you don't do crypto. Well, we can't because it's fiat. So in the parameters that we have, we're trying to make sure we're cash long. Yeah. The biggest problems typically when markets collide is that a liquidity event turns into a market riot. And that's what we need to really look out for.
Given the diversification and the risk assessment you've already been making, do you anticipate further weakness in US assets?
It depends on what will happen over the next few months. Well, the biggest risk is that people lose fundamental trust in the future of the US financial system. And that's something, no, we don't. But I'm an optimist who is very careful. So call me a careful optimist.
Let me turn the conversation to Europe, because much of last year was about European competitiveness, big fiscal packages coming, German fiscal package this year. And in the context where we're now talking about a further challenge with an ally, a reliable ally and a trading partner, what does Europe need to do to ensure it does have its competitiveness intact, that its blueprint is fit for the future?
Yeah, we are far from being fit for the future. That's not a surprise. We have been over-consuming. Now, 50% of the world's social spending is happening in Europe, where we have 5% of the global population. It's completely absurd. Everyone knows that. But the problem is, if you're an elected official, how do you take something away from people that they think they now are entitled to? So the biggest issue that we need to steer money away from pretty short-term consumption to longer-term investment. And in Germany, a lot of that is happening. But we're far from being ready because we have the money now. Now we need to organize and implement the proper reforms, and they are still hanging somewhere.
So rather than worrying about the crisis on the other side of the Atlantic, you've just identified a very clear and present long-term danger, by the way. I remember when we were in Paris in, I think it's 2017, when Macron first got elected, and it was a great big worry then as well. He has failed, and a lot of events have conspired against him, but he has failed to rein in that spending at the heart of Europe as well. We've got to be concerned about what's going on, because the populists are on the rise, whether it's in Germany, whether it's in Italy, whether it's in France, whether it's in the United Kingdom as well. I can't see that scenario you're talking about improving.
Yeah, it's not about the populists. People are just very unhappy, whoever is the ruling party, whether they're left and right, because outcomes for citizens haven't improved, right? Think healthcare costs. Inflation and healthcare costs is 3 times GDP. By the way, going back to our own country, I don't want to comment on others, we haven't had growth for 6 years. But at the same time, we keep on, again, spending 6 to 7% more on healthcare every year. We are doling out money to the world. And, you know, in Berlin, the warning signs are about to hit, but as long as the money keeps on coming in terms of tax revenues, but that's changing now. My prediction would be in the next 2 to 3 years, there's going to be so much pressure on public households because we have massive bankruptcies, reduction in workforce. Right. I keep my fingers crossed. But the worry for me, Germany is not, or France is not like we're going into default or something terrible. You know, my favorite country in the world other than Germany is Italy. And remember, since 1994, they haven't been growing their economy. Right. So my worry is about, you know, irrelevance in a longer period, because we are just keep on, you know, spending money and keeping people happy. That is my worry.
Italy also needing those structural reforms. But just quickly on climate change, we seem to be seeing a lot of backtracking. European leaders, their pathway to net zero, they want it watered down. NBIM, the oil fund, yesterday was also talking about a slower pathway to net zero. Is net zero dead now in Europe? Is it just a matter of time?
No. I think it is not net zero. Anyone like me who has children will have to worry about the future of the planet. Many of you here in the room have that too. It's an aberration that short-term people are saying, you know, we can do that. We see the impacts everywhere. Now, we had less than normal Nat Cat last year, but everywhere you have firestorm. I think it's about doing it intelligently. And by the way, the role model here is China. They're going to be the leader both in terms of renewable and cost of energy. In our country, we're not doing it well. You can put up a solar panel anywhere in the world and the government pays for the connection fees. It's crazy, right? So we need to come to terms, do it properly, think about it long term and keep steering it. This is what we do in Allianz. We said 250 is net zero. Let's not try to say, I need to already do it by 235. Bullshit, excuse my language, on TV. But focus on and delivering it. We have in our company reduced energy consumption for us more than 40%. It can be done, but let's not make it a religion. Right. Make it a target and then keep focusing.